Gary from Michigan worked for 31 years at the same company. He saved every bonus. He maxed out his 401k, and when he finally retired, he had $500,000. Gary wanted one thing, a paycheck that never stops. So he put it all into SCHD. 12 months later, he checked his account. The dividends added up to about $17,000, around $1,400 a month. Gary was disappointed. He thought it would be more. Here's the thing Gary didn't know yet. That $17,000 was just the starting line, not the finish. By the end of this video, you'll see what happens to that income over 7 years and then 14. The numbers are going to surprise you. And the part most people miss? Your original $500,000 doesn't get touched. It stays right where it is, or it grows. But there are real risks too. And one of the biggest changes in the fund's history just happened last month. I'll show you what that means. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Let's get into it. Here's your SCHD $500,000 dividend income projection. Your first $17,000. What year one actually looks like. SCHD stands for the Schwab U.S. Dividend Equity ETF. It's a basket of 100 companies that pay dividends and raise them consistently. Names you already know: PepsiCo, Coca-Cola, Merck, Texas Instruments, Chevron, United Health Group. Massive, profitable businesses. Every company in SCHD has been paying growing dividends for at least 10 consecutive years. That's the minimum requirement just to get in. Right now, SCHD pays a yield of about 3.35%. On $500,000, that's roughly $17,000 in year one, about $4,250 every quarter, 4 checks a year. And the expense ratio? Just 0.06%. About $300 a year in fees on $500,000, almost nothing. Here's something important. SCHD has never cut its annual dividend, not once since the fund launched in 2011. Not during COVID, not during the 2022 bear market. That doesn't mean it can't happen, but 14 years of unbroken growth is a strong record. And here's what separates SCHD from high-yield funds that advertise 8 or 9%. Those funds often eat into your principal to pay that yield. Your investment shrinks every year. That's a trap. SCHD works the opposite way. The starting yield is lower, but the dividends grow, and your principal stays intact or grows along with them. So $17,000 sounds modest, but what if that number doubled every 7 years from the exact same shares? Let me show you.
The dividend growth engine, years 7 and 14. Here's where things get interesting. SCHD doesn't pay you the same amount every year. It raises the dividend. Over the last 10 years, SCHD grew its dividend by about 10.7% per year. Compound that, and a modest starting income turns into something remarkable. But I need to be straight with you. The last 3 years were slower. The rolling 3-year rate is closer to 7%. A bigger dividend base is harder to grow at double-digit rates. That's just math. So instead of picking one number and pretending it's guaranteed, let me show you 3 real scenarios. In the conservative scenario, 5% growth per year, your annual income goes from $17,000 in year 1 to about $22,700 by year 7. By year 14, you're collecting over $32,000 a year. That's a 6.4% yield on your cost. In the moderate scenario, 7% growth. Year 7 reaches $25,500. Year 14 pushes to nearly $41,000 a year. Your yield on cost hits 8.2%. And in the historical scenario, 10% growth, matching the actual 10-year average. Year 7 jumps to over $30,000, and year 14 reaches almost $59,000 a year. That's an 11.7% yield on your original $500,000. Stop and think about that for a moment. Even in the most conservative case, your income nearly doubles in 14 years. In the best case, it more than triples. And you haven't added a single dollar. You haven't sold a single share. Your $500,000 is still sitting right there. And in most historical periods, it's grown too. Let's put that in real terms. At the moderate 7% growth rate, your monthly income goes from $1,400 to over $3,400 by year 14. That's an extra $2,000 a month from doing absolutely nothing. Here's the myth. SCHD's dividend will always grow at 10%. Here's the truth. The growth rate has slowed in recent years, and the smartest investors plan for all three scenarios, not just the best one. Now, most financial advisors would tell you to forget about dividends entirely. They'd say just follow the 4% rule, pull $20,000 a year, and hope the money lasts. But there's a problem with that approach, and it's the one thing that keeps retirees up 3 in the morning. SCHD dividends versus the 4% rule on $500,000. The 4% rule is the most famous retirement strategy ever created. Developed in 1994 by financial planner William Bengen. The idea is simple. Withdraw 4% in year 1, then increase by inflation each year. Based on historical data, your money should last at least 30 years. On $500,000, that's $20,000 in year 1, $3,000 more than SCHD's $17,000. So the 4% rule starts ahead, but watch what happens. In year 1, the 4% rule gives you $20,000. SCHD gives you $17,000. The 4% rule is winning. By year 7, the rule gives you $23,000 about after inflation adjustments. SCHD at 7% growth gives you $25,500. SCHD has pulled ahead. By year 14, the rule gives you $27,500. SCHD at 7% growth, nearly $41,000. At the historical 10% rate, almost $59,000. But the income gap isn't even the biggest difference. Look at the bottom row. Under the 4% rule, your principal declines. You sell shares every year. Under SCHD, your principal stays intact or grows.
This is where sequence of returns risk becomes a real threat. Let me explain that in plain English. Imagine two neighbors in Tampa, Sandra and Ray. Both retired January 1st, 2022 with $500,000 each. Sandra followed the 4% rule. She pulled $20,000, but the S&P 500 dropped over 18% that year. She sold shares at the worst time. Those shares can never recover for her. Ray held SCHD and lived off dividends. SCHD only dropped about 3%. His dividend actually grew almost 14%. More income, 0 shares sold. That's the real difference. The 4% rule forces you to sell. SCHD lets you sit tight and collect a growing paycheck. Before I show you the risks, and there are real risks, drop a comment right now. Are you already invested in SCHD, or are you still researching it? I read every single comment, and I want to hear where you are in your journey. 3 risks every SCHD investor must know. So now you know the income math. You know how SCHD compares to the 4% rule. But here's where most YouTube videos stop. They show you the upside and skip the risks. That's not how we do things on this channel. There are 3 real risks with putting $500,000 into SCHD, and one of them just happened last month.
Risk number 1 is dividend growth is slowing down. The 10-year average is 10.7%, but the 3-year average is only about 7%. 2 of the weakest growth years in fund history, 2023 at 3.8% and 2025 at 5.4%, are both recent. Plan for 7% and you'll be pleasantly surprised if you get 10.
Risk number 2, sector concentration. After the March 2026 Reconstitution, SCHD reshuffled 25 stocks in and 22 out. About 55% of the fund is now in 3 sectors: consumer staples, healthcare, and energy. Only 14% is in technology versus more than 30% for the S&P 500. That's exactly why SCHD lagged the market badly in 2023 and 2024. It missed the AI boom entirely. Risk number 3, tax drag. In a taxable brokerage account, you owe taxes on every dividend. At the top qualified rate, that costs nearly 1% a year. Over 14 years, that's tens of thousands of dollars.
Hold SCHD in a Roth IRA instead. Zero tax. That single move could be worth $50,000 over the life of your investment. And here's one more thing I want you to know. SCHD has never been tested through a truly deep recession. Global dividends fell over 12% during COVID. In the 2008 financial crisis, S&P 500 dividends dropped about 21%. SCHD wasn't around for either of those. It launched in October 2011 after both crises were over. Its perfect dividend record is real, but it's untested under the worst conditions. Smart investors know the difference between untested and impossible. They plan for both outcomes. So here's what all of this comes down to. One decision only you can make. Prepared retirees don't chase the highest number on a spreadsheet. They build a plan they can actually stick with through good markets and bad ones. SCHD is not a magic bullet. No single investment is. But it does something very few investments can do. It pays you a growing income stream while keeping your $500,000 intact. Whether you use the conservative 5% scenario or the historical 10%, the math is real. The companies are real. The 14-year track record is real. The question isn't whether SCHD is a good investment, it's whether it fits your plan, your tax situation, your timeline, your comfort with risk. And if you decide it fits, remember this: hold it in a Roth IRA if you can. Plan for 7% growth, not 10%, and never sell shares just to pay yourself. Let the dividends do that job for you. The goal isn't to spend your money. It's to spend what your money makes and never run out. If someone you know is sitting on savings and trying to figure out what to do with it, share this video with them right now. It could change the way they think about retirement income forever. Tell me in the comments, would you put $500,000 into SCHD today? Or would you split it between SCHD and something else? I want to hear your plan. If you're building retirement income and want to stay ahead of changes like the March Reconstitution, subscribe to this channel. I cover everything that protects your income every single week. Next week, I'm breaking down what happens when you combine SCHD with one other ETF and why that pairing might be the strongest retirement income engine you can build. I'll see you there.